So, welcome to the weekly Saturday knowledge sharing webinar organized by Mehta and Mehta Training and Knowledge Foundation. Our today's topic is an insight into dividend, including SS-3. Our presenter is Ms. Nayan Handa, partner Mehta and Mehta, in charge of Delhi branch. Our today's panelist is Mr. Rajendra Chopra. To formally introduce, welcome Mr. Rajendra, and he has already been there on our program. So thanks again for your time. To formally introduce our panelist, CS Rajendra Chopra is an associate member of ICSI and law graduate with 28 years of experience in corporate sector. He is associated with CIPLA for past over 8 years, is presently heading the secretarial function for the group as a company secretary. He is a member of FICCI and the CII Corporate Law Committee, and he is a speaker at various events organized by chambers, professional bodies, other bodies. Welcome, Rajendra Bhai.
Thank you.
Thanks for your time.
Thank you for inviting me, actually.
Thank you. And we have with us today's presenter, Ms. Nayan Handa. She is a fellow member of ICSI, brings a wealth of expertise and commendable track in field of secretarial and corporate law, of total experience of around 9 years, with 7 years post-qualification, 2 year pre-qualification. She is handling our Delhi branch. As usual, our today moderator is Sudhakar Sarvatullah and Mr. Bala. No one needs their introduction. They are always there. Welcome, Mr. Sudhakar and Mr. Bala. And as regards to say something on today's topic, we have done this topic earlier also, as you people know. And that time also we had many questions. And I was just talking to Mr. Rajendra, same thing, that the topic remain, the law remain the same. But as the time passes, new circumstances, new situation, the changes in other law, other countries affects our own law and its implementation. And it require revisit again that how we handle the situation. People may be wondering why SS-3 we have added when it is not law. Friends, SS-3 or Secretarial Standard, which are law and which are not law, still our savior. There is a guidance note. Please read that. Why? Not because I was Secretarial Standard member and Sudhakar is Secretarial Standard member, Standard Board member, but the thing that it gives you the guidance to navigate the difficult situation. And if tomorrow you are questioned, you can say that you have relied on the guidance issued by your own institute, which itself a state, and it is some authority that gives you the justification of your decision. And that's why, and it really solve your issues. That's why, friends, Secretarial Standard, whether they are part of Act or not, and guidance note, please keep the copy with you or keep that open with you and refer always. Dividend, it's thought that small topic, but boss, it has many, many things because money is going out to the shareholders. It's timing, when to declare, the process to be followed, overseas investors, the type of investors, the taxation, also non-payment, IPF, the issues in the law and the practicality, also the kind of company you are. If NBFC, there is some specific requirement. If you have borrowed the funds, there can be some conditions by the lender. Please keep in mind while declaring dividend. These are the various topics I just narrated, but there will be various interesting discussion we'll take through when we'll take out the presentation. With this, I'll request Mr. Rajendra to say a few words on the topic, then Sudhakar and Mr. Bala, and we'll start sharp at 11:50. Thank you.
Thank you, Dipti. I think this is a very, very relevant subject, especially given the timing presently most of the companies are going through their annual compliances, which include AGMs, the dividend, and the approval of financials, etc. And this become most critical. I was speaking to Dipti, and Dipti said that there are a lot of questions which are coming up, and there were a lot of people have a lot of queries on this. I said if the people read the law, they have a lot of queries. If they don't read, there is no query, and they are very clear. So if you have a question, that's a sign that you really understand your subject well, and it's very natural to have these questions. Important point is that we should discuss those questions and reach to the logical conclusion and what should be the secretarial practice on these points. So looking forward for this participation. Thank you for inviting me.
Thank you. Sudhakar.
Thanks very much, Dipti, and good morning to everyone. As Dipti has rightly mentioned that we dealt with this topic during our masterclass on Companies Act 2013. But as you all aware that for the past few weeks, we are dealing with all the topics pertaining to the annual report because this is, as Rajendra has mentioned, this is the timing for the AGMs. We dealt with the notices for the board meetings and the AGMs. The same point of time, we are done with BRSR reporting. We did with board's report. We did with the role of CS in the financial statements. Now, this is more or less the last topic as far as the annual report is concerned, that is dividend. There are certain topics in Companies Act which are all evergreen. You discuss as many times as that, but the nuances are going to be there. Dividend is concerned, several times company secretaries take it very lightly because not much changes are there as far as the dividend related provisions are concerned. But one of the very important and significant corporate action is declaration of dividend. Boards must be very, very responsible while recommending the dividend or while declaring the interim dividend. Because board has to see the financials before getting that. It is though that shareholders crave for a dividend, they always demand dividend. Board should not come under the pressure and declaring the dividend, or boards should not tend to declare dividend to manipulate the market share price also. It is a very responsible decision. And at the same point of time, whatever is the responsibility of the board, according to me, it is the responsibility of the company secretary. The company secretaries have to fully in sync with the board as far as its responsibility in declaration of dividend or recommendation of dividend is concerned. So the company secretary's responsibility is to ensure that proper financial statements are presented to the board based on which the decision is to be taken by the board as far as the recommendation of dividend is concerned. At the same point of time, as I was mentioning to you, that board should not be too liberal in declaring the dividend. Because if you see the debt equity, when we talk about, equity is a very costly game. Because the interest what you paid on the debt is going to be adjusted against the tax. Whereas the dividend is not tax-free as such. You have to pay on the profits which you are distributing, you have to pay tax on that. At the same point of time, if you declare very high dividend this year, the expectation of the shareholders in the coming years will be much more than that. So the board has to always keep in mind that about servicing the dividend is concerned. And though in the Companies Act, it is not mandatory for declaration of dividend at a board meeting. That is, according to me, it is not a correct thing. There are several issues, several actions the board, or several decisions the board has to take only at the board meeting by way of a resolution. As far as dividend is concerned, that sort of requirement is not there. Several times people ask this question that, can we pass a circular resolution? In fact, when we were drafting SS-3, that point of time, this issue has come up. And we said that the board should not declare the dividend by way of a circular resolution because of the importance and the significance what this decision carries. Board has to understand the financials completely. It has to see what sort of requirements are going to be there in the next 5 to 10 years. Whether the profits, whatever you have earned, they have to be plowed back or they have to be spent. So the board should be, according to me, very conservative as far as the dividend decision is concerned. And finally, I would like to say that if the board take an irresponsible decision of declaration of dividend, and again they find difficult in disbursing that dividend for whatever the reasons it is going to be what's called as attract severe and stringent penal provisions, including the imprisonment of the directors. And as 127 says that due to any reason, if the dividend is declared but not paid, the directors are going to be imprisoned as well as the monetary penalty is there. So this is a non-compoundable offense also. So this also further what's called as support my this thing that this decision is a very crucial decision as far as the board is concerned, and what sort of nuances are there as far as the dividend procedural formalities are there, that we will discuss over the presentation of Maya. So I give a pause here and request Bala to take it forward.
Good morning to all of you. I have a great pleasure in welcoming you all for this knowledge session organized by Mehta and Mehta. As our panelists said, this topic is very, very important. Many of you would be actually aware, as per the listing regulation is concerned, the companies are required to have a dividend policy as such. What is their policy, how they are going to there? It is there. It is actually mandatory for the 1,000 top companies actually as per the market capitalizations. Many companies do have the dividend policy. As Sudhakar puts it very correctly, when you want to declare the dividend, whether company's requirement is there to plow back the money, they need the investment, or they need the money for the business purposes, etc. Those things are there. And again, coming to the borrowings, if the borrowing is the repayment, because as he rightly said, many times there is a nominee shareholders, nominee directors who are there actually from the lenders, financial institutions, or bankers, who will definitely try to see their interest is safeguarded. So with all these things are all there, company secretary has plays a very, very important role. In fact, the directors are depending upon the company secretary for doing the right thing. Many of the regulators have already stated, once the company secretary is appointed in the company, it is the responsibility of the company secretary to ensure the compliance and not of the director. Directors depend upon the company secretary. There are a lot of things out there. And second thing, I also like to touch upon what initially Dipti said about the secretarial standard, which are non-mandatory, and also the guidance note. Many of you would be also aware, nowadays, increasingly, the regulators in their adjudication order or even the appellate order by RD, they are increasingly not only referring the secretarial standard, but also they are referring the guidance note very frequently. They are actually questioning the company secretary, have you actually followed the guidance note which is introduced by your institute itself, which you are supposed to do that, you have failed to do that. That sort of the speaking orders are also coming. That shows the very importance, whether it is mandatory, non-mandatory. We have to adopt all the standards, and we'll have to see it is not only going to help to the greater extent to us, and we'll be doing the right thing at all the right time and ensure the compliance. That's what I would like to say here. Of course, there are a lot of things which keep on coming. This is not the first time we are discussing this topic. The topic is again repeated topic which is being discussed. But every time we discuss, we discover new things, new interpretation, new things which comes upon. We have a learned members, Mr. Rajendra and Sudhakar. They will share their personal experiences and other thing and all circumstances depending upon whatever the clarification you ask. I would request all of you, like in the past, please put down your queries and doubts, etc. and other thing on the chat box. We'll be taking then and there. It will be addressed. Thanks.
Thank you.
Over to
Nayan, start sharing the screen, Nayan.
Yes, so good morning, everyone, and a very warm welcome to this webinar. And thank you for joining us today for the session on the dividends and the Secretarial Standard 3. So over the next 2 hours, we will be looking into the legal, regulatory, and the practical aspects which is governing the dividend distribution. So let us start by establishing this foundation, understanding what is a dividend. So a dividend is a distribution of a company's earning to its eligible shareholders, typically paid out of the company's net profit, serving as a reward for their investment. So as you know, at its core, a dividend is a distribution of a company's earning to its eligible shareholder. And typically paid out of the company's net profit. It's tangible way of companies to share their success directly with those who have invested in their group. So the companies face a very crucial decision when they accumulate the retained earnings. So they essentially have two primary paths. First, they can reinvest this earning back into the business. So this could be the fuel future growth, expand operations, pay off their existing debts, or simply to build up the reserves for the future needs and contingencies. And alternatively, the management can decide to distribute a portion of these profits directly to the shareholders as a dividend. So this provides the immediate return to the investors and can enhance their shareholders loyalty and the market confidence. So this decision making authority for these distribution is usually vested with the board of directors, and they have access to the company's financial health, future plans, and the regulatory requirements to determine the dividend policy. So we have interim dividend, which are declared by the board of directors during the financial year. And there are final dividends, which are initially recommended by the board of directors, but their actually declaration requires the approval of the shareholders. So moving to this, the key regulatory framework that governs the dividends. So understanding, so first we have the Companies Act 2013. So this is the foundational law for corporate governance in India, and highlighted here, Section 2, Subsection 35 of the Companies Act inclusively defines dividend to include any interim dividend. So this is a broad definition that covers the various forms of distributions, and the Act recognizes the two main type of dividend on their declaration process, that is interim and final. So we have the Secretarial Standard, that is SS-3, which is issued by the Companies Act Institute of Company Secretaries of India. So this plays a very important role in the procedural guidance and bring the uniformity in the dividend practice. So SS-3 gives the dividend as a return on their investment made in the share capital of the companies as distinct from the return on borrowed capital, which is in the form of interest. So the commercial usage, the term dividend refers to the share of profit of a company that is distributed among its members. So finally, then we have a SEBI LODR. So LODR doesn't give any specific definition to the dividend, but it defines, instead it is focusing on ensuring that there is a governance and there is a disclosure requirement, and there is a procedural obligation for the listed entities, which is concerning the dividend and declaration and the distribution process. So this includes the mandate for the dividend distribution policies, timeline for intimation to the stock exchange, rules for the record dates, all of which we will explore in the further slides.
Let's go back to the previous slide.
Yeah.
See here, as Nayan has mentioned, that Companies Act has given a dividend definition, which is simply that dividend includes any interim dividend. Whereas in Secretarial Standards, also it has defined the dividend, and SS-3 also has defined the interim dividend. Not only the dividend, it also defined the interim dividend. One may ask this question that why SS-3 has defined a dividend already since a definition is there. Please note that the definition of dividend as well as interim dividend and SS-3 is concerned. That is to enable the people and to appreciate that what is the dividend and interim dividend provisions which we are talking about in SS-3 is concerned about. So as on date, SS-3 is not mandatory, it is only recommendatory. And in fact, SS-3 has come into force, if I am not wrong, from 1st January 2018. So it is almost 7 years we have completed. But several times when I ask this question that whether anybody has gone through the SS-3 as well as the guidance note on that, of course, the answer is not very encouraging. But my submission to all the participants here is to kindly go through the SS-3, whether you comply with or not. But if you want to appreciate the provisions pertaining to the dividend declaration by the board and the related governance provisions are concerned, which have been elaborately discussed in that. And there are several contentious issues are also there, which we will discuss over this webinar. Those issues have been explained with the rationale for that in the guidance also. Yeah, go ahead, Ryan.
So now we're going to discuss about the categorization which is given under the Companies Act. So while there are various forms of dividend in the market, so which primarily recognize the types on their declaration process and their nature. So first we have the interim dividend. So this is the most common type of dividend that is paid out in cash. And the key characteristic here is that interim dividend is declared solely by the board of director during any financial year. So this can happen at any point, even after the financial year has closed, but before the AGM is held. So it is a way of companies to distribute the profit more frequently, often on a quarterly basis. So based on the company's performance during the interim period. So the next we have the final dividend, which follows a two-step process. So initially recommended by the board of directors. So after the company's audited financial statement are prepared and adopted, so the crucial second step is that it must be then declared by the company's member or the shareholders at the AGM through an ordinary resolution. So while shareholders have the power to declare it, they can only declare a lower rate than what the board recommended. So they cannot increase the proposed amount. And finally, there is one more dividend which is recognized under the Companies Act. So that is a preference share dividend. And these are dividend which is specifically declared for the preference shareholders. And the shareholders hold a preferential right to receive a fixed amount or a fixed rate of dividend before any dividend is paid to the equity shareholder. So the preferential right is a key feature of preference shares and ensuring the more predictable return for their investors.
Now, just 1 minute again. See, since we are on the preference share dividend, some people have a wrong notion that since the coupon rate is already decided at the time of issue of preference shares, there is no separate requirement to declare the dividend on the preference shares, which is not so. It is not a right to have the dividend on the preference shares. It is only a preference when the dividend is declared on the equity shares as well as the preference shares. Preference shareholders will get the preference over the equity holders. Suppose there are no profits. Do you think that it is mandatorily the preference shareholders are to be paid the dividend agreed upon? Answer is no. If there are profits, even then also that it is the responsibility of the directors to consider whether to declare the dividend or not. But as far as the preference shares are concerned, since already there was an agreement or a coupon rate was decided, it is imperative for the directors, if the profits are there, they have to pay dividend as far as the preference shareholders are concerned. If there are no profits, it is not mandatory for them to declare the dividend on preference shareholders. So, however, as we all know that there are two types of preference shares, one is cumulative and one is non-cumulative. As far as the cumulative shares are concerned, even if you are not declaring dividend this year, the dividend gets accumulated, which is to be paid, if not today, tomorrow, day after, but at the time of redemption, definitely they have to be paid. Sometimes it may so happen, the cumulative shares, the redemption date has come and those shares have been redeemed, but that they could not pay the dividend. Even after redemption of the preference shares also, the accumulated dividend still is a debt and is to be paid to the preference shareholders. Rajendra, I request you to kindly give your comments also on this particular aspect.
Good point. So the question comes, if the company has profit and company does not declare dividend on preference share, in that case, even after redemption, it remains the liability of the company. But if the company doesn't have profit before the redemption, then there is no liability of the company. This is my, this is my understanding. Company never had sufficient profit that it could declare dividend, because preference share dividend is subject to the availability of the profit.
Yeah, I slightly differ with you. As I told you that there are two types of preference shares. One is cumulative and one is non-cumulative.
Correct.
As far as the cumulative preference shares are concerned, even if the profits are not there, the dividend gets accumulated over a period of time and it becomes a debt. when you are redeeming the preferred shares, at that point of time, if the company is not in a position to pay the dividend, but that dividend will stop, the meter will stop there at the time of redemption. And after that, whatever the accumulated dividend is there, that is to be paid definitely by the company, unless until that accumulated dividend is waived by the concerned preferred shareholders. It becomes a debt otherwise. And as far as the financial statements are concerned, in the notes to accounts, you have to give a note that this much debt is outstanding as far as the cumulative shares are concerned. And this we have done in 2, 3 of our companies in Reliance, and subsequently, when the profits were there, we have paid the dividend also. Yeah.
Sudhakar, you are absolutely right, actually, because if you look at the index, the presentation is slightly different here. Because what they say is, although we say preference share is the capital, but in India, the treatment is preference shares are actually treated long-term borrowing. And not only that, whatever the dividend which is actually committed, which has been actually shown as a financial cost, not by way of the dividend. In fact, in some of the companies where I was working, since it is already committed in the financial cost, it is going to the profit and loss account. Definitely speaking, why do we need the declaration by the board of directors? That question has been actually asked actually. But the
No,
thing
when
is,
when I say this, that is not the rational or logic, because that is only a way of Ind AS and the
no,
IGAP is
no,
there.
no,
Those are only presentation. That is
no,
not the
no,
law.
no, that is right. But the thing is, how you are treating it in the books, that's all. Because one
Yeah.
thing is there very clear. It is actually a committed amount which is to be paid to the preferred shareholder. That is very clear. So as you rightly said, yes, the cumulative dividend is to be carried over. It has to be shown in the balance sheet. It is actually so much the due. It always remains the liability. That is the case, 100%. And I also agree with you, whatever you said, non-cumulative, that point is absolutely correct because it remains the debt. Yeah.
So, Sudhakar, if the company doesn't have profit till the redemption, and the very concept of dividend is dividend has to be paid out of profit, how does the dividend accrue to a company, to a shareholder?
See, it is a
I
contingent
agree till
liability.
the
What happens,
redemption, till the
Rajendra, what happens is in the notes to accounts, you have to show it as a contingent liability, because in case of cumulative dividend, that is the purpose. If you see the act also, on the cumulative preference shares, the dividend gets accumulated over a period of time.
fully agree.
And
Fully agree on that.
yeah.
See, the only difference is it has to remain, it has to accumulate till the dividend, till the shares are redeemed.
Correct.
But once the shares are redeemed and company did not have profit, company could not have paid the dividend, and dividend by its very nature under 123 can be paid only out of the profit. So company didn't have profit till the security existed, and once the security has ceased to exist, it cannot accrue the liability in future. The very concept of accumulation ceases once the dividend, the preference shares are redeemed.
Rajendra, what you are saying is correct. Actually, the accumulation ceases from the time when the redemption has been done. But
Correct.
so far, whatever is occurred, that is actually a committed debt which has to be paid from the profit when the company earns the profit.
Exactly, I agree. I'm saying if the company doesn't have profit till the redemption.
That is right.
See,
so that is why they could not pay. So that remains as a debt. But
that
whatever the
cannot
debt
remain
of,
as a debt. See, preference share dividend cannot be a debt. It becomes the debt only once it is declared. It cannot remain as a debt in the books. It can remain as a contingent liability, I can understand, but it cannot stand as a debt in the books of account if the company doesn't have profit. See, dividend, very different. The very nature of dividend, the difference between dividend and interest is that interest is fixed. It's a liability on the day it is accrued. It doesn't have to be approved. If you borrow the concept, what you are explaining, which means there is no need for any declaration because we are saying that this is fixed. The preference in case of accumulation, the preference is given to the shareholder, and before you declare dividend on equity share, the cumulative dividend has to be paid to the preference shareholder if it is a cumulative dividend. But if it is not a cumulative, but if the company doesn't have profit, even though the preference share has cumulative dividend, it cannot pay the dividend because company didn't have profit, and dividend can be paid only out of profit. Which provision did we refer when we said that the dividend can be paid out of the profit even post redemption of the preference share? Which provision, or how did we interpret this provision?
The issue is in case of cumulative preference shares that if you are not making the payment in the year in which it is supposed to be paid, or first year, second year, third year, whatever it is during the tenure, that it becomes a debt by default because of that understanding at the time of issue of the securities itself. You are committing that the dividend will be paid on an accumulated basis. That is the agreement what you are entering into in case of cumulative preference shares, number one. Number two, that because it becomes a debt which is getting accumulated over a period of time, only difference is it is not a compulsion for you to make the payment at the time of redemption. At the time of redemption, your obligation is you have to redeem the preference shares. That point of time, whatever the dividend got accumulated, it continues to be a debt as far as the company is concerned. And as and when that contingent liability, it gets fructified, as and when the company gets the profits after writing off the depreciation and the carry forward losses, before you declare any equity dividend, you have to make that payment on the cumulative preference shares. In case of for any reasons whatsoever, if the company is not in a position to pay that, and that contingent liability note, the company for whatever the reasons wants to remove it, it has to approach and the cumulative preference holders and get that waiver. Unless until it is waived, you cannot remove the note of the contingent liability also.
Okay. Now help me to understand, and maybe we can discuss this
So
separately.
Rajendra, what we will do for the sake of the time, we will park this question. Okay?
Yes.
And we will move on and we will discuss this separately if the time is there. Otherwise, off the line, we can discuss this.
I was about to say this.
Thank you.
So moving on to the provisions of the Companies Act 2013. So particularly Chapter 8, Section 123, it governs the declaration of the dividend. So Section 123, Subsection 1 says no dividend shall be declared or paid by a company for any financial year except provided that before the declaration of the dividend, first, out of the profits of the company for that year arrived at after providing or depreciation in accordance with the provision of subsection 2, or out of the profits of the company for any previous financial year arriving at after providing the depreciation in accordance with the provision of the subsection and remaining undistributed out of both or the both. So, in a short, we can say firstly, it is out of the profits of the dividend can declare only out of the profits of the current financial year, but only after providing for the depreciation, which is to be done in accordance with Schedule 2 of the Act, and secondly from the undistributed profits of any previous year or years again after providing for the depreciation for those respective years, and that allows and also the Act allows for a combination of both current and the past profits. So before declaring the dividend, the company may transfer any percentage of its profit to the reserves as it deems fit. And this is, a discretionary power for the board to strengthen the company's financial position. And moving to section 123 1B, we see the another permissible source where the dividend can be paid out of money which is provided by the central government or a state government specifically for the dividend payment and in pursuance of the guarantee given by the government. So provided further that if current profits are inadequate or absent, so dividend can be declared from the free reserves of the previous years only as per the rules prescribed in this behalf. And it also reinforces that the dividend shall not declare unless the previous year's losses and unprovided depreciation are set off against the current profits. So further to elaborate these conditions, which is declaring the dividend when profits are inadequate or absent. So with this comes the Rule 3 of the Companies Act, declaration and payment of dividend. 2014 come into the picture, and it clearly states that he provided further that where the owing to inadequacy or absence of profit in any financial year, any company proposes to declare dividend out of the accumulated profit earned by it in previous years and transferred by the company to the free reserves, such declaration of dividend shall not be made except in accordance with such rules as may be prescribed in this behalf. So these rules include the condition such as the dividend rate not exceeding the average of the last 3 years, the total withdrawal from the accumulated profit not exceeding the 1/10 of the paid up share capital, which we're going to discuss the rule 3 in the further slides. And finally, it also, provide restrictions ensuring the capital protection and the financial discipline, which gives that provided also that dividend shall be declared or paid by a company from its reserves other than free reserve. So this specifically means the reserves like securities premium account, capital redemption reserve, revaluation reserve that cannot be used for the dividend distribution. And again, in another provision, it is provided that no company shall declare the dividend unless carried over the previous years and depreciation not provided in the previous year or year are set off against the profits of the company for the current year. Section 123(2) states for the purpose of clause A of subsection 1, which says the depreciation shall be provided in accordance with provision of the schedule 2. So this means that before a company can declare a dividend from its profit, it must first account for the depreciation of its assets strictly as per the useful lives and method which is prescribed under Schedule 2 of the Companies Act. And this provision is critical for ensuring that only the true distributable profits are paid out and preventing the erosion of the company's capital base. Section 123(3) covers the board of directors of a company may declare the interim dividend during any financial year or at any time during the period from the closure of the financial year till holding of the AGM out of the surplus. So this provision grants the board the flexibility to distribute the profits to the shareholders more frequently than just annually. So interim dividends can be declared from the accumulated surplus in the profit and the loss account or from the profits generated in the current financial year on the quarter, which is immediately preceding the declaration date. So this allows company to give reward to their shareholders based on the ongoing performance, which comes with the provision that provided that in case the company has incurred losses during the current financial year or up to the end of the quarter, which is immediately preceding the date of declaration of interim dividend, so such dividend shall not be declared at a higher rate. So this proviso comes as a safeguard that if a company is experiencing the losses in the current financial year or up to the preceding quarters, so it cannot declare an interim dividend at a rate which is higher than the average of the dividend it's paid in the previous 3 financial years. And this prevents the company from making the unsustainable distributions during the periods of financial stress and protecting both the company's stability and the investors' interest. Section 123, subsection 4 covers the amount of the dividend, which is including the interim dividend shall be deposited in a separate bank account in a scheduled bank within 5 days from the date of declaration of such dividend. So this is the critical requirement under Section 123, subsection 4 of the Companies Act, which ensures that once a dividend is declared, the funds are promptly segregated and secured in the dedicated bank account, so preventing their diversion for other purpose and reinforcing the company's commitment to its shareholder. And then section 123 subsection 5 says no dividend shall be paid by a company in respect of any other share except to the registered shareholders of such share to his order or his bank and shall not be payable except in cash. So it clarifies that if dividend must be paid to the shareholders whose name appears in the company's register of member or as a beneficial owner on the depository record of the record date, or to their designated order or a banker. So the fundamental principle here is that dividends are payable only in cash. There are two provisos which is given to section 123 subsection 5. First states that the provided that nothing in this subsection shall be deemed to be prohibited the capitalization of profits or reserves of a company for the purpose of issuing the fully paid up bonus or repaying on any amount for the time being unpaid or any share held by the members of the company. So this is the clarification that while dividends are generally cash distribution, so this proviso ensures that act does not prevent a company from issuing the bonus shares by capitalizing its profits or reserves. So this is a distinct corporate action from the dividend payment. And the second part clarifies the mode of cash payment, which says provided further that any dividend payable in cash may be paid by check or warrant in any electronic form. So this expands on the payable in cash requirement, so which is allowing the modern electronic payment method, which is increasingly preferred for their efficiency and security. Now comes the section 123 subsection 6, which says a company failing to comply with section 73 or 74 regarding deposits cannot declare dividend on equity shares until such default is rectified. So this provisions covers emphasis on the financial discipline and investor protection. If a company has default on its obligation related to accepting or repaying any deposits under section 73 or 74, so it is barred from declaring the dividend on its equity shares until that default is rectified. So this is a strong deterrent against the financial mismanagement and prioritizes the repayment of the public deposits.
And go back to the previous slide.
Yeah.
See, in this subsection 4, it says that the amount of the dividend, including interim dividend, shall be deposited in a scheduled bank in a separate account within 5 days. Several times this question comes that, sir, can we use the same bank account where nil balance is there? Normally, in case of listed companies, what happens is definitely there will be some outstanding dividend amount, unpaid or uncashed will be there. So there is no issue. You have to continue that account separately only. So listed company secretaries never ask this question. It comes only in case of closely held companies and private limited companies that is it required that we have to transfer to a separate account because I have only 2 shareholders or I have 5 shareholders, 10 shareholders. I will make the payment from my current account only. I will do it in the immediate day one itself. I will distribute it. Do I need to open a separate bank account? Whether we like it or not, Act requires a separate bank account is to be opened. You have to deposit that money in that particular bank account. From there only you have to distribute the dividend. Tomorrow, if the regulator comes, certainly he will, if you are not opening a separate bank account, but you are disbursing the dividend from your current account, it amounts to a non-compliance. Number one. Number two, suppose you opened the account, you transferred that money. Day one itself, you have distributed that dividend. And next year, you are not closing that account. Next year, you want to use the same account. So can we do that? Okay, answer is maybe you can use that account, but please remember one thing. When the regulator comes for any inspection or investigation, you have to establish that for payment of every year dividend, you have to open a separate bank account. If you are using the same account, how you will establish that? So what you have to do is when you are opening a bank account, you say dividend, then you mention financial year so-and-so. And after that, you make that, you transfer the amount from there, you disburse the money, have the account statement with you. Next year, change the caption of the...
Sudhakar, your voice got disconnected. Can you repeat again? Sorry.
So what I'm trying to say is that in case of private companies, open a separate bank account, transfer the dividend amount to that account. From there, you disburse that. The balance has become zero. Don't close the account, keep that account. Next year, change the caption of the account, dividend for financial year so and so. So with this, what will happen is you will be able to establish that from the bank statement itself, the caption of the account is so-and-so company, dividend account, financial year so-and-so. Unless until you do that, it amounts to a non-compliance. Please remember this. Now let me come to subsection 6. Subsection 6 talks about the financial position of a company which has accepted the deposits, but which has not repaid the deposits on the date of that maturity or the interest thereon. In such case, the company cannot declare dividend. Very surprisingly, that there are several instances where the company can default, but they are not barred from declaration of dividend. So the way you are not making the deposits, you are not repaying the deposits, you are not redeeming the debentures. You are not making the payment on interest of those debentures. You are not redeeming preferential shares, not making the payment of dividend on that. Not only that, the dividend what you are declared, you might not have disbursed that. Even then, you are not barred from declaration of dividend for next year. So these are few issues which were identified, which are equally amounts to that as if it is a non-repayment of deposits in SS-3. In fact, that Nayan will give, I think, in her future slides. Those cases also, you are not supposed to declare the dividend. Because what you can say, that dividend you have declared this year, you are not disbursed it, and again next year you can declare the dividend. The global promoters who are there, they want to cheat the shareholders, they can do that thing because there is no legal constraint as far as section 123 is concerned. Yeah.
One more thing, Sudhagar, when you talk about the subsection 4, the subsection 4 very clearly says the amount is to be transferred within 5 days.
Correct.
It is not 5 working days. Correct. Many times people say in between the holiday comes, can we actually exclude holiday? Can we transfer? All those things people are asking the question. Even today also there is a question is there on this question. To be very frank with you, it is a quite amount of the planning you know to do. It has to be done within 5 days, whether you like it or not. There is no question of excluding the holidays at all. There has been cases where adjudication officer have actually penalized in such cases. People have interpreted that way. That is the thing. There is no question of talking about the holidays to be excluded or something like that. It is within 5 working days. It actually shows quite a good amount of the planning is required from the company secretary side.
Mr. Rajendra, any view, any comments by you?
Sorry, did you ask me?
Yeah. You have any view or comment, please?
No, I was just trying to absorb what Sudhakar and Bala said. Separate bank account, I 100% agree that it has to be deposited in a separate bank account. And I agree that there are many companies who try to interpret the law that if the dividend is paid before 5 days, there is no amount which is required to be transferred to the dividend account. But the law is the law. It says that you need to deposit the amount within 5 days, and from there you need to pay. So if you don't deposit the amount in the bank, we don't know how the jurisprudence will work on this, but you definitely, the companies who practice this run the risk of a regulatory process on such practices. The question comes whether I need to open a separate new bank account every year, right? The law says that a separate bank company shall deposit the amount in a separate bank account. And what is the meaning of a separate bank account? Means it should not be an account which is used by the company in its day-to-day operation. Now, in my opinion, while the safe interpretation is open a new bank account every year and then deposit the amount and then you are all compliant. But it is also possible to say that, okay, I'm using this account dedicatedly only for the purpose of payment of dividend, and the companies have to demonstrate this. And that bank account, if it is used year-on-year basis, it should be fine with that. There was a discussion that we can request the bank to change the nomenclature of the account every year. practically banks now, because of the automation and processes, do not have that flexibility of changing the nomenclature. Even if you want to change the name of an individual because of marriage, etc., or name of the company because of change of name, they request to open a new bank account. They don't entertain the request of changing the name of the company. This is my view.
I fully agree with you, Rajendra. In case of such difficulty, ultimately at the end of the day, what happens is you should be able to demonstrate that you are complied with the provisions of subsection 4. If you are able to do that, nothing like it. These are only the ways and means, actually say that, which at one point of time we were adopting it. But now if there is a difficulty in changing that caption of that particular account, say for example, after 30 days, the dividend account what we have opened, it should be called as an unpaid dividend account. That is to be transferred to that. So what we do is we don't open a separate account. In the resolution itself, we empower the banker
to change the
after
nomenclature.
30 days to change the nomenclature of that account. So that kind of a thing may be done. What will happen is it becomes easy for the company secretary to establish before the regulatory authority that he has complied with subsection 4. However, having said that, ultimately the practical or pragmatic view is to be taken by the concerned officials.
Correct. Yeah. I agree.
Yeah, Nayan, go ahead.
I think one principle which we should keep in mind is that our business is not to fight with the regulator. How best you can plan and save the company from any process or any proceeding of a regulator or any questioning is your expertise. So I agree with you, Sudhakar. I can't agree more.
One more thing also, considering the regulatory activism, though pardon my saying that word, I am using it, that every company secretary has to by merely complying with the law is not, you have to establish that you are complied with the law. For that, whatever the documentary evidence is there, that you have to do it, because you cannot create a documentary evidence at a later stage. At that point of time only, you visualize that tomorrow if the regulator comes and questions me, how I will be able to do that. That is the only reason I always say that your auditors, whether it is secretarial auditor or a financial auditor, to be strict with you. Don't go for a soft auditor. If the auditor is strict with you, then what will happen is just like there is a saying in the army court, if you bleed in the peacetime, you don't need to bleed in the wartime. So if you sweat in the peacetime, you don't need to bleed in the wartime. This is an army standard quotation. I always adopted that in my practical life, my 40 years of corporate life, wherever I used to say that if I sweat it today, I don't need to bleed tomorrow. Same is the case here. If you are able to create the documentary evidence today, you don't need to worry at all. Yeah.
Correct.
To have a good secretarial auditor or a statutory auditor. That's what my recommendation is.
Yes.
And which we ensure. Normally, every company secretary ensures it. Yeah.
Yes, Nan.
Yeah. So as we already discussed about section 123(1), so here I'm going to give some, specific financial foundations from which we can say these are the permissible sources for dividend declaration, which we've already discussed. But just for give a brief, there are the permissible sources for dividend declaration. That first is out of the profit. The company can declare out of the profits of the current financial year. So this is not just any profit. It must be the profit which is arrived at after providing for the depreciation in the strict accordance with with Schedule 2 of the Companies Act. And alternatively, the source of the dividend can be from the profits of any previous year, financial year, that remains undistributed. So again, after duly providing the depreciation for those years, which is given under section 123(1)(a, and finally the dividend can be paid from the money which is provided by the central government or the state government, which specifically for the purpose of dividend payment. So it is equally important to understand that what cannot be considered as a profit for dividend distribution. So Act includes the key exclusions from the profit calculation as per proviso to section 123(1). So when computing the profits for the dividend purposes, though there are certain amounts which must be explicitly excluded. So these are like unrealized gains, notional gains, and revaluation of assets. So any change in the carrying amount of an asset or liability, so resulting from the fair value measurement. So this strict definition of a profit is very crucial to understand, and it prevents the company from paying the dividend out of the inflated assets or non-cash gains.
Yeah, here also one thing, sorry, I'm in fact everywhere I'm actually blocking your Nayan, but
No
this is
problem, sir.
imperative
Yes.
for me.
Yes.
See, here what happens is when we talk about the profits, the term profit is not defined under the Companies Act. So profit is to be taken as per the profit and loss account, post tax, whatever is available for distribution, that is to be taken into account. Now the question comes about previous year's profits. That means the profits which are not transferred to reserves, which are parked in the profit and loss account only. I always give a standard example of PPF account and a savings account. The moment you put the money in the PPF account, you cannot touch it. The moment the money is lying in the savings account, you can do it the way you want to use it, you can use it. Similarly, here also, the moment you transfer it to reserves, if you want to declare the dividend out of that reserves, the reserve rules are to be complied with. But if that profit is lying in the profit and loss accounts, that means surplus in the profit and loss account, you can use it the way you want it without complying with the reserves rules. Several times people ask one question that if you see the definition of free reserves, the surplus in the profit and loss account is not a part of free reserve as such. But for the purpose of 186, we do take that surplus in the profit and loss account together with the free reserves, while for working out that whatever the limit, threshold limits and all are there. But in this case, whenever you are declaring the dividend out of your surplus in the profit and loss account, that means the profits of previous years, you don't need to comply with the reserves rules. That's what I'm trying to say. Number one. Number two, let me also take this opportunity to say that before I may forget that, you can declare dividend out of the free reserves subject to the compliance with the rules, but you cannot declare interim dividend out of free reserves. Interim dividend can be declared, the sources of that are separate. That Nayan will come in the next slide, I think.
Yeah. One important point, Sudhakar, I will add to what you said.
Yeah.
Yeah. And this is especially very common in private limited and closely held companies, that there are accumulated losses. The company has huge profit in the current year, and the companies declare dividend out of the current year's profit without setting off the previous year's profit. This is very common error you will find in the closely held and private limited companies. Because now the provision very clearly says after setting off the previous year's losses and depreciation. So this need to be kept in mind.
And also let me add one more thing. People are also under the wrong impression that when you are declaring the dividend out of free reserves, even then also you have to set off, first of all, the depreciation.
Yes.
You have to set off the losses. You have to ensure that preference shareholders are there. You have to make that payment. Uske baad jo bhi bacha kucha hai, then only you can make that equity shareholder dividend. Otherwise not.
Very right.
Payment of dividend out of reserves, that doesn't mean you will not set off the losses or depreciation.
Correct.
So declaration of dividend is a very, very conservative issue. Depending upon, if you have financial strength, you can declare dividend. If you are hollow, you cannot declare dividend.
Correct.
So here we have some mandatory conditions or restrictions on the dividend declaration. So first, we have the requirement for the set of losses and depreciation. So the Act, mandates that any previous carried over losses and unprovided depreciation from the prior financial year, it must be set off against the profit of the current year. So before any dividend can be declared. So this is again a fundamental principle. and it prevents the distribution of capital disguised as profit. So next is the restriction. There is a strict prohibition on default. A company is explicitly barred from declaring any dividend if it has certain critical financial obligation, which includes the repayment of deposits or repayment of interest thereon, and redemption of debentures, payment of interest, redemption of preference shares, or certain or a creation of capital redemption reserve, and payment of any dividend declaration, and repayment of any term loan to a bank or financial institution. So this is the extensive list which clearly gives the hierarchy of a financial obligation and prioritize the commitment to creditors and depositors over the immediate shareholder return. So thirdly, we have the sources of reserves. The act is very specific that dividend can be declared from the free reserves, and it explicitly exclude the certain reserves from being used for such dividend declaration, like the securities premium account, capital redemption reserve, revaluation, amalgamation reserve, profit on reissue of forfeited share, and profit prior to the incorporation of the company. So this prohibition underscores the capital protection from the principal, so ensuring that companies' capital is not eroded by the dividend payouts. So finally, there is a declaration from free reserves in inadequacy or absence of profit. So while current profits are the primary source, the Act allows dividend to be declared from the accumulated profits. And however, this is subject to the stringent conditions which are given under Rule 3, which we are going to discuss in the next slide. And these conditions include the limit on the rate of dividend, the total amount that can be withdrawn, and the mandatory utilization of the drawn amount to set off the current losses. So there is a minimum balance of free reserves after the withdrawal should be maintained, and allow the companies a degree of flexibility to manage the investors' expectation during the lean period. So here comes the Rule 3 of the Companies Act declaration and the payment of dividend rule 2014. So first, this covers the regarding the rate of dividend. As per Rule 3, Sub-Rule 1, the rate of dividend declared in such a scenario cannot exceed the average of the rates at which the dividend was declared by the company in the three immediate preceding financial year. So this conditions prevent companies from making unusually high payouts from the reserves, and which could jeopardize their long-term financial health. And however, there is a practical expectation that this rule does not apply if the company has not declared any dividend in each of the three preceding financial years. Second, the concerning the total withdrawal limit, Rule 3, Sub-Rule 2 stipulates that the total amount withdrawn from the accumulated profits cannot exceed the 1/10 or 10% of the sum of the company's paid up share capital and the pre-reserves. As presented in the latest audited financial statements, and this act as a cap which gives the significant portion of the company's capital reserves remain intact and prevent the excessive depletion. Then comes the Rule 3, Sub-Rule 3, that amount so drawn from the accumulated profit must be first utilized to set off any losses incurred in the financial year in which the dividend is declared. So before any dividend in respect of equity share is declared, the prioritizes the covering the current losses, reinforcing the principle that dividend should ideally come from the genuine and sustainable profit. And then finally comes the regarding the balances of reserve after the withdrawal, that is covered under Rule 3, Sub-Rule 4, which mandates that after such withdrawal, the balance of the free reserve must not fall below 15% of the company's paid up share capital. So as per the latest audited financial statement, so this act as a minimum threshold, ensuring that a company retain a healthy level of reserves to absorb the future shocks and support the ongoing operations. So, sir, anything you would like to add?
Yeah. See, in this case, only thing what I want to add here is all these four rules are to be complied with in alignment with each other. It is not or. It may so happen that your first average dividend, it might be coming to say 10%, suppose, for example. And the amount what you can withdraw, 1/10 of the paid up capital and free reserves, it is enabling you to pay maximum of 8% only. So even if your average dividend is 10%, but you cannot pay 10% because the amount what you can draw as per the rule 2, the next rule is only it will enable to make you the payment of 8%. It may so happen the second rule is allowing you to withdraw that amount. You can pay even 12% dividend also. But first rule is putting a cap of 10% only. Suppose, for example, first rule, second rule are in alignment, but the third rule, you have to leave a balance of 15% of paid up capital free reserves. If that is not satisfied, again, first and second cannot be put in place. So you have to ensure that all these 3 or 4 rules are to be in alignment. Only then you will be able to make the final payment to the share, that dividend. And then if you want to add anything further on that.
No, very clear. And this rule also apply if you want to pay dividend on preferential. It is not only on the equity.
Even in this case also, first you have to pay preference shareholders dividend and then only you will be able to pay. Okay, one more thing before I forget. By any chance, suppose whatever the sources are permitted, only out of the sources only you have to make the payment of dividend. Say, for example, you are not knocked off the depreciation and losses, but you paid the dividend. Then what will happen is it may amount to payment of dividend out of the capital. That is illegal. In fact, okay, that if I am not wrong, earlier we used to have a section 208 under the old act, wherein it said that you cannot pay interest out of the capital. You cannot even pay the dividend also out of capital if happens like that. That means you don't have profit. You are still making the payment of dividend. Means what? You are actually paying out of capital only. So that is illegal and the directors will face that consequences accordingly.
Correct. So true.
Yes, go ahead, Nan.
So we can have a consolidated view on this legal framework for the dividend. That first we have the permissible sources, that current year profit, previous year undistributed profits, and the government guarantees. And then we have impermissible sources, that is securities premium account, capital redemption reserve, revaluation reserve, amalgamation. And then there are key exclusion, that is unrealized notional gains and the setting of the losses. So moving to the section 124, which is covering the unpaid dividend account. So here it deals with the shareholders unclaimed dividend, which is to be handled systematically and transparently. Section 124(1) says where a dividend has been declared by the company but has not been paid or claimed within 30 days, the company must, within 7 days after that, transfer the unpaid and unclaimed amount to a special account in a scheduled bank called the unpaid dividend account. And this is a strict timeline which is mandated by section 124(1) of the Companies Act. It ensures if shareholder does not claim their dividend within 30 days, the company cannot retain these funds indefinitely, and instead they must be moved to the designated separate bank account within the additional 7 days, so that the rights of the owner should remain. Section 124 subsection 2 says the company shall within 90 days of transfer prepare the statement with the name of the shareholders, which is last known address, and the amount of unpaid dividend, and it must be placed on their own website and other government approved website. So this brings the transparency and accessibility of the information for the shareholders by making these detailed publicly available, so the company can facilitate the process for shareholders to identify and claim their unpaid dividends. Section 124 subsection 3 says if the company has made default in transfer the amount of the unpaid dividend account, it may pay 12% interest per annum on such amount. So this is a penalty provision, we can say, to bring the strict compliance. And if a company fails to transfer the unpaid dividend amount to the designated unpaid dividend account within the stipulated 7 days period, so they are liable to pay the interest at a rate of 12%, per annum on the defaulted amount. So this brings the avoid the delays and ensures the company's accountability. Section 124, subsection 4 says any person which is entitled can apply to the company to claim the unpaid dividend from the unpaid dividend account. So the shareholder who missed the initial payment can still claim their dividend from this account. However, it is important to note that any amount remaining in the unpaid dividend account for the period of 7 years from the date of its transfer, along with any accrued interest, it must be transferred to the IEPF. So before this transfer to the IEPF, the company is required to send an individual intimation to the concerned member at least 3 months prior to the due date. Once transferred to the IEPF, shareholder would then need to follow the prescribed procedures as per the IEPF authority to claim their funds. Section 124, subsection 5 covers if the dividend
Just one important point. There's a requirement to upload the name and the detail of the shareholder whose dividend has remained unpaid on the website of the company and also with the MCA, IEPF, etc.
Right.
One thing to be kept in mind is that now there are data privacy laws. And also there are fraudsters who are active in the market on dividend and the unclaimed share. So while statutorily they can upload, but there has to be security features, and only the right person is able to see their detail. And therefore, most companies, what they do is they put the detail, but it can be accessed only if certain level of security, questions are passed through. So this is also important because we have seen some of the companies, they have just uploaded the name and the detail on the website in the PDF.
Yeah.
Which, while it is compliant of the company law, it exposes the company, it is also violent of the data privacy.
Correct. In fact, there are several, that broker type of people.
Yes.
Based on this data, they used to approach the people that we will get your account having this much amount of dividend. We will help you and we will get a cut in that also. All those things used to happen like that.
Not
You
only
rightly
this,
said, yeah.
Not only this, they backtrack and they check the information whose dividend has remained unpaid for 7 years. Then
Correct.
they also have
Yeah,
potential number of shares. So they claim shares and dividend. They actually approach the shareholder for both shares and dividend. Actually, there are also instances, and SEBI and MC are struggling with this, that they are impersonating the individuals and claiming the dividend and shares from the account of the government as well as the company.
Rajendra,
And
in
they have
fact,
been successful in this.
see, these days, fortunately, most of the issues are happening in the electronic mode only. Wherever the old companies are there, which are 25, 30-year-old companies, you used to have that. Still, there are several people holding the shares in physical mode. A lot of legacy issues used to be there. That somebody has already got the duplicate certificates and transferred the shares. You are not even aware of that. All this kind of nonsense used to happen. So company secretaries are to be very careful whenever this kind of data is uploading and all. You have to have the security features properly in place. I agree with you.
Correct. Go ahead, man.
Thank you. Thank you. So in this slide, we're going to cover section 124, subsection 5. It says if the dividend remain unclaimed for 7 years, the company must transfer the amount with the interest, if any, to the IEPF and send a statement of details of the IEPF authority for which the authority issue a receipt to the company as evidence of such transfer. So this is mandate by section 124, subsection 5 of the Companies Act, and which means that any amount dividend that remain unpaid or unclaimed in the unpaid dividend account for the period of 7 years So that date has to be the date it was transferred to that account, along with any accrued interest, must be transferred to the company to the IEPF. And this fund is managed by the central government, and it is dedicated to promoting the investor awareness and protection. So the company must also provide a detailed statement to the IEPF authority as evidence of this transfer. Next says section 124 subsection 6 says the share on which the dividend has remained unpaid or unclaimed for 7 consecutive years or more must be transferred to the IAPF along with the detailed statement. So that claimants can reclaim such shares from the IAPF by following the prescribed procedures and submitting the required document, if any. And the provision is there given that if a company has not paid or claimed dividend on any shares for 7 consecutive years, so the provision clearly states that the rightful claimant, the shareholders or their legal hire, can reclaim these shares from the IAPF by following the procedure given and submitting the necessary document. So then comes the section 124 subsection 7, which covers the penalties for the non-compliance of this section. For company, 1 lakh plus 500 per day till such a failure in case of continuing default, subject to the maximum of 10 lakh rupees. For defaulting officer, 25,000 plus 100 rupees per day till such failure in case of continuous default. So subject to the maximum of 2 lakhs. So these penalties are there if you non-comply. So as we can, see, there is a clear visual representation of process for managing the unpaid dividend account and this subsequent transfer of funds. So the process begins if a dividend is not paid or claimed within 30 days from its declaration date. So the 30-day window is the initial period for the shareholder to receive the claim their declared dividend. So following this, if the dividend remains unpaid or unclaimed after these 30 days, the company has a strict obligation that within 7 days from the expiry of that 30-day period, the company must transfer it to the special account in a scheduled bank called the unpaid dividend account. And this is a very critical step to segregate and safeguard these funds. And once the funds are transferred to the unpaid dividend account, the company has further compliance requirement. So within 90 days of this transfer, the company must prepare a statement for the disclosure of dividend. And this statement includes the details such as the name and the last known address of the shareholders and the amount of unpaid dividends. So this statement must be placed on the company's own website and other government approved websites to facilitate the claims, and along with taking care of the Data Protection Act. And finally, if the amount remains in the unpaid dividend account for an extended period, a final transfer occurs after the 7-year or more. So any amount remain in this account along with any accrued interest, it must be transferred to the IEPF account, and this fund is managed by the central government. So this is the entire process from the initial 30-day period to the eventual transfer to the IEPF, and which is designed to ensure the transparency. Now we are going to cover section 125 of the Companies Act, which establishes the IPF fund is IPF fund. So section 125 subsection 1 says the central government must establish the IPF, and this is the commitment by the government, which is, there is a dedicated mechanism for the investor welfare. And 125 subsection 2 showed the list which gives the income flow into the IEPF, that is grant from the central government, donation from the central state government, account from unpaid dividend accounts, amount in the general revenue account transfer under the old section 205A of the Companies Act that are still unpaid or unclaimed. So balance from the earlier IPF, which is covered again under section 205C of the Companies Act 1956, and interest or income from the fund investment, amount received under section 38 subsection 4, application money received by the companies for allotment of securities, mature deposit with the companies other than bank, and interest on the amount in H2 J, which we have discussed here, and sale proceeds of fractional shares, and finally such other amount as may be prescribed in this list. So provided that no such amount referred to in clauses shall form a part of the fund unless such amount has remained unclaimed, unpaid for 7 years. So this clarifies that certain categories of funds, specifically those related to the application money, mature deposit, and mature debentures, only get transferred to the IAPF if they have remained unclaimed and unpaid for a period of 7 years. Then section 125 subsection 3 says the fund shall utilize for the following purposes, and which is the list is given, like for the refund of unclaimed dividend, mature deposits, application money, so promotion of investor education and awareness protection, distribution of disgorged amount to affected shareholders, and reimbursement of legal expenses for class action suits under section 37 and 245 with the tribunal approval, and any other incidental purpose which may be prescribed by the rules. Now we're going to cover section 127 of the Companies Act, which gives the detailing the punishment of failure to distribute the dividend, and this impose several penalties to ensure the strict adherence to the dividend payout obligation. Section 127A says where a dividend has been declared by a company but has not been paid or warrant in respect thereof has not been posted within 30 days from the date of declaration, and then. So this sets the trigger for the penalties, and the law mandates that once individual dividend is declared, it must be paid or the dividend warrant dispatched within 30 days. So failure to meet this timeline, it leads to the consequences. Following to this, every director of the company shall, if he is knowingly a part of the default, be punishable with the imprisonment which may extend to 2 years and fine which shall not be less than 1,000 rupees. So this highlights the serious personal liability for directors who are knowingly involved in such a default, and includes the potential imprisonment and significant daily fines. So further, the company itself is also penalized. It says the company shall be liable to pay the simple interest at the rate of 18% per annum during the period for which such default continues. And this gives the company bears a financial cost for its own failure to disburse those dividends promptly and compensating the shareholders for the delays. So now the proviso provides a crucial exceptions where no offense under this section shall deem to have been committed. Proviso A says where the dividend could not paid by the reason for the operations any of the law. So the situations where legal impediments prevent the payment, and there is exception when there is a shareholder has given a direction to the company regarding the payment of the dividend, and those directions cannot be complied with, and with the same has been communicated to him. And then where there is a dispute regarding the right to receive the dividend, in case of legitimated disputes, ownership of entitlement, the company is protected. So, and also there is where the dividend has been lawfully adjusted by the company against any sum due to it from shareholders, or where any other reason the failure to pay the dividend or to the most warrant within the period under this section was not due on to any default on the part of the company. So these are some exceptions.
I think a lot of questions are there. I think before we move to the listed companies and
Yes,
thing, okay, we'll take a questions.
I think, Bala, there are one or two things are still there.
Yeah.
I don't know whether Nayan has covered the sources from which you can pay the interim dividend. Sources of final dividend, we have discussed about it. But about the sources of for the declaration of interim dividend, I don't know whether she has dealt with or not. But definitely that interim dividend can be paid by the board of directors under subsection 3. Subsection 3 was introduced by the Companies Amendment Act 2017, wherein it is now explicitly clear that the board is empowered to declare an interim dividend. Several times the question comes up, is that can we declare more than one interim dividend? Answer is yes, you can. It is prerogative of the board to declare as many interim dividends as it wants to. In addition to that, the money out of which the interim dividend can be declared is profits of that year, profits of the previous years. Not only that, even profits of the current financial year. That means the year after the year which was for which you are going to declare the interim dividend, from the quarter which was closed prior to the quarter in which you are going to declare the interim dividend. Say, for example, now we are in the financial year 25-26 and financial year 24-25, which was closed. But if that accounts are still not adopted at the AGM, you can declare the interim dividend as on date. That means on 12th of July, suppose if the board meeting takes place, I can utilize the profits of 24-25. I can utilize the profits of the previous financial years prior to 24-25. I can also utilize the profits of the current financial year. That means April to June quarter. The profits, if any, are there, which can also be used for making the payment of interim dividend is concerned for the year 24-25. So that means what? Interim dividend is not the dividend which is declared during the financial year. Interim dividend is a dividend declared between two AGMs. Number one. Number two is that can the dividend declared be adjusted against any outstanding debts of that shareholder? In case of listed company, you cannot adjust against any of the outstanding debts of the shareholder except that the costs and arrears, if any, and the interest thereon, that can be adjusted. Having said that, in case of the unlisted companies are concerned, if their articles clearly provides for adjustment of any debt outstanding of the shareholder, they can do that thing. Finally, I would like to say that the declaration of dividend, that means the final dividend which is to be approved by the shareholders, has to happen only at the AGM because it is an ordinary business. It cannot be transacted at the extraordinary general meeting, or it can also be not transacted by way of a postal ballot also. One more question is that it is a contentious issue. In fact, Rajendra, I would also like to have your review on that, is whether the interim dividend is to be approved by the shareholders, whether it is to be ratified by the shareholders, whether it is to be confirmed by the shareholders. Prior to companies, my view, I'm telling you that prior to Companies Amendment Act 2017, there were two schools of thought was there, because the clear mandate was not there to the board to declare the interim dividend. However, several companies' articles used to permit the board to declare interim dividend. Even that time also, one school of thought was the moment the board is empowered to declare interim dividend, there is no need to get it confirmed by the AGM or by the shareholders. However, now in the present act, subsection 3 clearly empowers the board. I mean, or it mandates the board can declare the interim dividend. So there is no question of any approval by the shareholders, ratification by the shareholders, or by confirmation by the shareholders. Your views, please.
So, broadly, I agree with your understanding and interpretation that the shareholder approval is not required. Why do some of the companies believe that interim dividend also require approval or ratification, whatever we call, from the shareholder? If we go into the genesis, in 1981, MCA issued a clarification letter where they said that the company's board of director can declare the interim dividend, but it need to be regularized at the AGM. We don't know what does regularization means. Was the interim dividend irregular when it was declared so that you're now regularizing? That remains unclear, but yeah, that was a letter which was issued and then it became a practice under 1956. to seek the approval or so-called regularization from the shareholder on the interim dividend. Now the law is very clear that the board of directors has a right to declare interim dividend. I think this old letter of 1981 can be grandfathered and there is no requirement. Now, if the companies do it, there is no downside of it, but absolutely no requirement to go for regularization.
For the benefit of the participants, let me also say this thing that in SS-3, we have given very clearly this view has been given in the SS-3 itself that there is no confirmation, ratification, or approval is required as such.
Yeah.
Yeah. Now we can take question or we'll complete the presentation. What you feel?
Yeah, we can take questions. Otherwise,
think
okay that if there is a small this thing is there, then quickly
Nayan, how
Nayan can
many
wrap it
slides
up.
are there? Nayan?
Yes, ma'am. There are 32 slides and we are on 17. So,
Oh
my
my God.
God.
12:30.
My God.
I think you
I
see
think
that
we'll-
list. One minute. Dipti, listing
Yeah.
regulations are concerned. It is only procedural part which we can skip through.
and then we can
Okay.
have it.
And there are one or two interesting case laws is there because see, there is no point of talking about the procedural part. Okay. Whereas the contentious issues are there, and then the questions of the participant, that is more important. So listing regulations, there is no contentious issues as such. More of procedural by intimation to stock exchanges and all the compliances and other things are there. So what I request you is that as far as SS-3 is concerned, Nayan, I have already dealt with that important provisions as far as SS-3 is concerned. You may skip through this also. Just go to straight away the case laws, and that also you can wrap it up in the next 5 to 7 minutes so that we can focus upon the questions. Because SS-3 to a large extent I have covered through your presentation itself.
Yeah.
Yeah.
Mr. Rajendra, if you want to give any comment, you can give in the conduct notes.
Yes. So we will allow Nayan to complete her presentation. Then we will answer the questions which we have received. And then if there is anything, we will definitely share.
Yeah, sure.
All the questions are posed to your Rajendra by default. Wherever I have to add something, I will do it. Yeah, and please go ahead.
So there are some landmark cases that first is Tata Consultancy Services Limited versus State Bank of Maharashtra and others. So in this case, the Bombay High Court held that a company cannot be compelled to declare dividend. So the court held that the power to declare dividends rests with the board of directors and shareholders cannot compel the company to declare the dividend. And in the another case, that Sri Chand P. Hinduja and another Hinduja Foundries Limited and others. So in this case, the Supreme Court of India held that the interim dividend can be declared and paid by a company during any financial year or at any time before the finalization of the accounts of that year. So the court held that the payment of interim dividend must be made out of the surplus in the profit and loss account and the reserves of the company. In the case that Rajan Nanda versus Jayant Nanda and others, so the High Court held that the declaration of dividend must be made out of profits of the company for that year or any previous years after providing for the depreciation or out of profits of the company for any previous year. So after providing for the depreciation and after setting aside an amount of reserves as may be prescribed. So the court held that a company cannot declare dividend out of the borrowed funds or the capital. Then comes the case that Commissioner Income Tax versus Author Holding Private Limited. So in this case, it was held that only the registered shareholders in the company's book are eligible to claim the dividend. So merely purchasing or receiving share does not entitle a person to dividend unless the shares are registered in their names.
Just one important point here. If you go to the previous slide on Rajan Nanda, while the court says that the company cannot declare dividend out of borrowed fund or capital, that is right. But if the company has sufficient profit, but it doesn't have a liquidity, it is okay for the company to borrow the fund and pay the dividend. That dividend payment will not be considered as a payment out of borrowed fund.
Absolutely.
Interesting. Yeah.
See that the liquidity issue is different and the having profits and other things is different.
Yes.
Despite the fact you have profits, that profits might have been invested somewhere. Instead of liquidating that, what you are doing is you are borrowing the money and then making the payment. So for eligibility to pay the dividend, you have to see that profits, reserves, and not the liquidity issue. Correct.
Correct.
Good point.
So there is a case in N. Kumar M.O. Rao, Assistant Director, SFIO. In this case, it was held that the directors who resigned before the declaration of dividend cannot be held liable for the non-payment or delayed in the distribution of dividends. Under the case of Kishi Chand Chelaraman versus Commissioner of Income Tax, in this case, it was held that if directors deliberately or negligently pay the dividends out of the capital, they must be required to compensate the company for the loss caused by such wrongful and negligible conduct. So in conclusion, we can say the concept of dividend goes far beyond just distributing the profit. It is the reflection of the company's financial strength and commitment to shareholders' value. So the dividends, whether in the form of cash, stock, property, or which is regulated by the framework of corporate laws and standards, so including the Companies Act, SEBI, LODR, Secretarial Standards. So this session, we explored the type and purpose of the dividend and the legal provisions regarding their declaration. So we understood that the dividends can only be declared from the genuine profits or free reserves and not from the capital or the borrowed funds. So SS-3's 3 lays down the clear procedural guidelines from the board recommendation to prevent the methods and the prohibits the dividend declaration in the case of default. So the key legal provisions are such as Section 123 to 127 of the Companies Act and related SEBI regulation mandates the strict timelines for the declaration, transfer of unpaid amount, and the detailed disclosure. So the IEPF mechanism protects the unclaimed dividend and enables the rightful claims to recover their entitlements. So we can conclude the slides here and move to the question answers.
Oh, just 1 minute, Diane, go to the previous slide. See, this transfer of unpaid dividend to the IEPF account and transfer of shares to the IEPF account, that there is a slight difference is there. People have to understand that. Number one, if a dividend is outstanding for a period of 7 years, that is to be transferred to IEPF account. That means, say, for example, we are in the financial year of 24-25. The 7 years before, that means 18-19. If any dividend is outstanding, unclaimed or unpaid of 18-19, today, that is to be transferred to IEPF account. That doesn't mean that corresponding shares are also to be transferred to IEPF account. As far as the transfer of shares is concerned, the dividend is not encashed for a period of 7 years. That means, suppose, say, for example, we are in the financial year 24-25. In a particular folio, if the dividend is not encashed right from 18-19 till date, then the corresponding shares are to be transferred. In between these 7 years, even if 1 year the dividend is encashed, the remaining 6 years the dividend is not encashed, still you don't need to transfer the corresponding shares to the IEPF account. So this is the difference between the transfer of unpaid dividend and the transfer of the shares are concerned to the IEPF account.
One
Number
more
2,
interesting point on this point.
just one more before it slips
Go
out of my mind, Rajendra. Several times it happens that the dividend amount is a very small amount, and if you are not given an electronic mandate, you will get a physical warrant. Several people used to, what they do is, who will go to the bank and deposit that, because it is a 10 rupees, 20 rupees, 50 rupees like that. People were not even encashing that. But post this transfer of shares are concerned, if you are having the same attitude and you are not encashing your dividend warrant for 7 years, all your shares will be transferred to IEPF account. So please be careful about it. If any of you are holding shares, not encashing the warrant, not given the electronic mandate. Yes, Rajendra, sorry.
Sudhakar, you made me worried. I will instruct now. This given me very, Thanks.
It's not 1 rupee or 2 rupee, it's the share which will go into IEPF. Correct. No, one interesting fact, Sudhakar. Suppose if a company declare dividend out of previous 7 year only for 1 year, which is first year. Say, for example, 18, 19, it declare dividend. It doesn't declare dividend for rest of the 6 years. The share will still go to IPF because the dividend has remained unpaid for 7 years.
Yeah.
These are the implications. I'm saying nuances of the law.
I agree with you.
Yes.
Okay,
Now we
let us
can
go
take up
through
questions,
the
Bala.
yeah. Dividend remaining unpaid for the period of 7 years, along with the shares are transferred to IAPF even if later dividend are unpaid. MRF decides interim dividend of rupees 3. According to this, rupees 3 dividend has remained unpaid for the period of 7 years, although later all dividends are not unpaid. In such a cases, will share of the MRF be transferred to IPF along with the rupees 3?
We just answered this question.
Yeah, we just talked about. If unpaid dividend is would be discussed in the next. Okay, this is the thing I had said actually. Can a private limited company distribute all its reserves having the return earnings only to its shareholders? Company has not actually distributed to any dividend in the past. Kindly consider the rule 3, 2, and 4 of the company's declaration of the dividend payment, dividend rules 2014. Can a private company limited can distribute all its reserve, etc., and other things and all, if the company has not declared any dividend in the past? That is the question. But I think we discussed actually, because she touched upon this particular rule, that is declaration of dividend and payment rules. She discussed about what are the 4 conditions. Even Sudhakar said all the 4 conditions.
No, it is not that. What the question is they are making the payment out of the reserves, and they have not declared any dividends in the previous 3 years. So the averaging question is not there.
Okay.
So they can make that, they cannot withdraw the entire reserves. They have to withdraw the reserves only to the extent of 1/3 of the paid up capital and free reserves, number 1. Number 2, they have to also ensure that the reserves should not fall less than 15% of paid up capital and free reserves. If these 2 conditions are complied with, then whatever the percentage is concerned, absolutely there is no issue.
Correct.
How to pay the dividend for the share which are transferred to IAPF account?
It will go to IAPF, correct.
Is it required to approve the members of the company for the interim dividend, or it is required
No. 1 minute. It is not the question, Rajendra. What the question is that the shares what have been transferred to IAPF.
Yes, so the dividend goes to IAPF.
Yeah, correct. Dividend also has to go to IAPF account with that particulars to IAPF authority.
Correct.
Okay,
let us also take one more opportunity here. Several of this question also comes. What about the bonus shares? What about the right shares? So please throw some light on that also.
So bonus share will be credited to IPF, but right share, because nobody exercised the option, this is a loss to the shareholder.
Correct.
Okay, next is actually interim dividend that we actually discussed whether it is required approval or not, etc. Then somebody says, I had asked the Institute for SS-4, they do not have the copy. Where do I get SS-3 and SS-4? In fact, the online you can actually download it. It is available on the site.
Available on the websites.
Yeah, it is available on the website. You can actually download it. As a company signed the earlier agreement with the preferred shareholder for its coupon rates, but the company is having a loss and is it not mandatory to follow the agreement with the reference to shareholders?
Yeah, actually the dividend on preference share is subject to availability of the profit. So even if the agreement, there is an obligation to pay dividend at the fixed coupon rate, it is always subject to the availability of the profit.
If the company has sufficient accumulated profit, then a provision should be introduced in the Companies Act to declare the minimum dividend, that is 5%, 10% profit to the shareholder or owners. They should also be allowed to declare dividend as their owners. This we cannot say because law is the law.
That is company policy.
Yeah.
Company can decide that, make a dividend policy.
Can it happen that the dividend are not being declared for the equity and only on the preference? There is an agreement with the CCP shareholder that they will be paid 0.5% dividend till conversion. This blanket resolution was passed in the company in the year 2019. Now the question, whether every year does the company required to pass the new resolution or since the agreement and blanket resolution already passed so that it can be considered? Please answer.
Okay, there's an agreement that the CCP assured that they will be paid 5 till conversion. The blanket resolution passed in company. No, it has to pass. Every year the companies will have to pass the resolution for declaration of them. Blanket resolution will not be sufficient.
Okay. If a company does not have the profit, even that time, company has to pay the dividend to a cumulated preferred shareholder, even if the board has not declared the dividend, whether such a dividend gets accumulated. No, if the profit is not, dividend cannot be, the dividend payable will be actually carried over. Because if the dividend is, the profit is not, dividend cannot be declared. But the amount which is actually payable in the state of the cumulative, that gets actually carried over the books of accounts.
Correct.
A company has accumulated profit not transferred to the reserve in the current year. It has incurred losses in the first quarter. Can it declare interim data out of the accumulated profit? It does not to be cleared any dividend in that last 3 years.
It so long as it has set off its current quarter's profit and the dividend profit is sufficient, it can declare interim.
But the quarter they have suffered the loss. They have accumulated profit and it has not declared dividend in last 3 years.
Which is fine. It has a balance in the profit and loss account. See, the 3 years, etc., need to be evaluated only if it is paid out of reserve. There is a balance in the P&L account. Technically, very technically speaking, the company has the ability to pay dividend.
Please confirm, pursuant to Rule 7 of the IEPF rules, whether we need to appoint the nodal officer even though the companies have no unclaimed dividend which are actually readily to be transferred to IEF account. For example, if the company has 4 years unclaimed dividend but are liable to be transferred to IEF only when they are paid after the completion of the 7 years, even in this case, whether the company needs to appoint the nodal officer. If I am not mistaken, the nodal officer requirement is there only at the time of crediting the account and not before that. So that means in this case, I don't think it is there. At the time of the crediting the amount, only the nodal officer appointed to coordinate and license the matter. That point of time only you need the nodal officer for that. Your views, Rajendra?
I also feel the same thing, but Sudhakar is the expert. Final view from Sudhakar.
Yeah, I see that when there is the note transfer to IEPF, only at the time of transferring it to IEPF, you have to inform who is the nodal officer and the details are to be also given on the website of the company.
Should the
Otherwise,
date of
not
the
required.
should the date of the dividend declaration be included when the calculating the 5-day period for depositing the dividend amount into the bank account?
It said within 5 days of declaration of dividend. So according to me, the date of declaration is also to be counted.
Absolutely right.
Yeah.
May a company pay bonus share?
And as you rightly said, Bala, that no holidays, nothing. It is not said within five working days. It is 5 days. So
Correct.
even the holidays are also to be counted.
May a company pay bonus share or split share without paying the dividend?
What is the question?
May a company pay bonus share or split share without paying the dividend?
Yes, it can.
Split share is not a
Capitalization
payment.
of profit is different and payment of dividend is different. They can do either.
Here the question, he says, can they pay bonus share and split share? Bonus share payment is okay. Split share is not the payment. Split share existing the share, cutting into the pieces. One cake of the cake is cut into 2 pieces. Is the bank account also required to be paying the fixed dividend as per the CCPS agreement preference shareholders?
Yes. Payment of dividend require separate bank account.
A separate bank account is to be opened for each dividend interim or final. Yeah, somebody has answered actually.
Yes.
My bank SBI is not allowing the open the dividend account with the SDFC. My company is actually listed. We should be allowed to open the dividend account with any other bank other.
Yes, we agree with him. They should be allowed, but this is the administrative thing which they have to deal with their banker.
Can we pay the final dividend or interim dividend out of the accumulated profit or previous year, but not transfer to the reserve account without any limit? accumulated profit remains in the profit or loss account, but not transferred to the Reserve Bank. Please say this. I think we discussed elaborately.
Yeah, we discussed. It is allowed.
Can transfer of the funds to dividend account be from a CC or overdraft account or from borrowings?
Yes, it can be. Subject to satisfaction of other conditions.
Can we close the bank account before 7 years if 100% is actually paid and the balance of the dividend account is nil in the listed company?
Yes,
you can close. Please give examples of money from the government for payment of the dividend. I think he is referring that slide where the government grant or something like that. That's what I think so.
Correct. This was the old provision when government used to guarantee the payment of dividend. Now it is no more relevant.
Opening a separate dividend account in a bank and the amount transferred to the bank account within the 5 days. My question is, for unpaid dividend account, company can open another one account for the same amount transferred. Please clarify. This I think we discussed about the separate bank account.
Yeah.
Even in fact, Rajendra touched upon today what are the difficulty in face of the automation, etc. and other things and other things. How can the government guarantee the dividend provided liquidity for a company is the payment of the dividend?
It doesn't do anymore.
Once the annual accounts are audited, the company has cumulative preference share. No dividend is actually declared as the equity share, and for the year under review, the preference share dividend is not declared. Then can the said dividend on preference share for the financial year be paid as interim dividend in July?
Interim dividend for the next financial year, but the books of accounts have been closed, so you can't practically declare the dividend for the previous financial year. Interim dividend can be declared now only in the current financial year, subject to satisfaction of the other conditions.
Yeah, interim dividend can be paid between the two AGMs, so long as AGM is not held actually. Even though your books and other things are all audited and other thing and all, still company can declare the interim dividend, because the interim dividend very clearly it says it is declared in between the two annual general meeting.
While the law says this, the practical challenge is, suppose you have closed your books of accounts for 24-25. Now you have to declare interim dividend for 24-25. You will be required to reopen your books, because you have to make the entry for the interim dividend of 24-25 in your financial statement of 24-25. So yeah, I'm saying practically you can't declare a dividend once the books of accounts have been closed.
Yeah. What are your thoughts regarding the waiver of the dividend by equity shareholders prior to declaration, after the declaration, before the deposit in the bank, separate bank account, and after the declaration or after the deposit in the separate bank account? Thanks. Ravi Prakash is asking very interesting
Sudhakar
question.
is the best person to answer this question.
As far as waiver of dividend is concerned, it is neither permitted under the Companies Act nor prohibited under the Companies Act. So unless until it is prohibited, it is permitted. You can take it like that. Second question is that when it becomes a debt, in case of interim dividend or final dividend, when it is declared, it becomes a debt. Now, there are three scenarios this gentleman has given, which is correctly so also. If the dividend is to be waived, before even, according to me, before even the directors consider the interim dividend or recommend the final dividend, before that, it has to go, that waiver request has to go to the to the company. And the board has to consider that they have received a waiver of the dividend. And it is entirely the discretion of the board to accept or not to accept that waiver request. You cannot compel the board that I am waiving the dividend. I have entitled for 1 rupee dividend. Don't give me that 1 rupee. You have to accept it. Transfer 1 rupee less to the bank account, etc., etc. No. It is entirely the discretion of the board to accept that waiver or not. That's why whenever you give the waiver, you have to give that rationale also for that. In fact, several of you might have been noticed in the RIL annual report is concerned. There was a waiver of dividend. And the rationale was also explained in the annual report itself that the subsidiary companies which were holding the shares of the holding company, they used to waive the dividend because ultimately it is the shareholder, because these are all treasury shares, and the shareholders of the holding company were the beneficiaries. Because of that, there is no point of getting the dividend, and also that there is to net off the dividend so that the funds can be utilized in a more better manner. Now, second question is that suppose the board has considered and declared the interim dividend, and then you are giving the waiver request. Can you do that? Nobody can stop you giving that request, but the moment that interim dividend is declared, it becomes a debt to the company, and they will make the payment to you, whether you want to accept it or not. That is your choice. Same is the case with the third scenario also. If they recommend the dividend to the shareholders and the shareholders approve that, it becomes a debt and the company is supposed to pay that. Company cannot say that you are sending a waiver request subsequently. They will not accept that. This is what the precise answer to your question. Now, another question is that how the income tax will view this kind of a waiver. Income tax will always say that it is a deemed income in your hands. You might be waiving it, you might be happy, but the income tax may say that this is a deemed income to you, tax it that thing accordingly. Then you have to contest your case with the income tax authorities.
Can we use amalgamation reserve for the declaration of dividend, and also whether the same can be used for the issue of the bonus share?
Then, if it is categorized as a free reserve, I don't know what is amalgamation reserve specifically.
Amalgamation reserve is not a free reserve. Amalgamation reserve is a capital reserve, and capital reserves are not permitted to utilize for the purpose of dividend. But only there is a issue. This thing is there. Any kind of capital asset, if you are selling it and you are earning that in cash, that cash can be utilized for that means that can be added to the profit. Say, for example, in your profit and loss account, there is a sale of plant and machinery is there. There is a sale of vehicles are there. Any kind of asset is there, and that you are realizing that profit in your profit and loss account. That profit can be utilized for the purpose of making the payment of dividend. In case of revaluation reserves, in case of amalgamation reserves, whatever are being created, these are all capital reserves. And specifically, it has been provided that they are to be excluded for the purpose of dividend.
If the company has not declared any dividend in any of the previous 3 years, can it declare any rate of the dividend subject to limit of the withdrawal from the reserve as per the rule? I think you discussed this. Yeah. Rule 3 is applicable cumulative for the declaration of the preferred shares and the equity dividend together. Any one? Rule 3 applicable cumulative for the declaration of preferred dividend and the equity dividend together. Anyone? I'm not getting
the question is not clear.
Yeah. No, declaration of dividend on the equity shares, declaration of dividend on the preference shares from the reserves. It didn't say those things. If the moment you are declaring the dividend out of the free reserves, whether it is on equity shares or on preference shares, you have to comply with the rules. That is the answer.
On default in transferring the unpaid dividend account to the unpaid dividend account to whom the stipulated interest has to be paid. On default of transferring the unpaid dividend to the unpaid dividend account to whom the stipulated interest has to be paid.
Technically, the dividend is paid to the shareholders, whose amount has remained unpaid. Is Bala's video is frozen, or it's a problem at my end?
No, he seems to be the dividend is.
I think I'll read out.
Yeah.
Section 124(2) state that unpaid dividend amount placed in the company's website and government website. Please clarify in government's which website? Any example? Please explain.
It's the MCA website. Yeah. IPF and MCA website.
NPA. What is the interest rate ceiling for unpaid dividend account?
What does it mean?
I know. Even
There is no interest
And
received.
interest.
Yeah, they don't earn any interest. It's a current account.
Yeah.
Correct.
This 90 days is after transferring dividend to unpaid
Yes,
dividend account.
yes, this is right.
Please clarify if once unpaid amount dividend transfer to IEP account, then the shareholder claim his amount from IPA
IPF
fund. Whenever, whatever amount B is eligible to get to 12% interest per annum will get with dividend amount.
No, he won't get any interest. Only principal.
If you
Please send-
declare, if you declare interim dividend declared out of current year's profit till the date of declaration, can this be included in the final dividend confirmed in the AGM
We have
as
discussed
final
this.
dividend?
We
Since the
have discussed.
dividend, sometimes shareholders don't update their bank details and address in DP records. Company paid dividend as per DP record. Is there anything can come on company, your view?
No.
Yeah.
So unless KYC is done, companies do not pay the dividend as per the new SEBI procedure.
Yeah.
First, the KYC has to be completed.
Sorry, some problem was there. I got disconnected.
Yeah.
No problem.
Would you be mailing the PPT as well as the
No,
VC webinar on this file?
No, leave it. Come next.
Okay. Suppose there is a litigation, amount of the litigant shares of the shareholders. If the legal had informed the company about the litigation, can the year period of extended till the litigation gets over? Now the litigation, you have to keep the things in abeyance.
If there
till
are,
the litigation
there
gets
are
started out.
court direction, if there is a direction from the court to keep the dividend in abeyance, then the companies can keep the dividend in its account with and not transfer to IPF. But if there is no mandate from the court, the companies will be bound to take it.
Profit for dividend declaration revert to the standards or consolidated profit in respect of the listed or unlisted.
So standalone or consolidated?
It will be a standalone, not a.
It's only a standalone. Correct.
It is a standalone, not a consolidated. Okay. You mean if the dividend is claimed in any 1 year among the 7 years, share will not get transferred IEPF account, correct?
Yes. Yeah.
That is correct. That's what he said actually.
Yeah.
Can a private company pay the dividend to its preferred shareholder from the regular current account, not from the separate account? I think this also we discussed.
Yeah.
Then the dividend payout policy has to be specified with the provident standalone and consolidated or to be considered payout. It is a standalone always.
Yeah. No, it has to specify. But yeah, it can have different parameters. But dividend has to be paid out of standalone profit.
And you clarifying dividend policy, that is Mr. Rajendra's use. Yeah.
Okay. If the companies invest profits in the acquisition of the fixed assets, later on, when the company wants to pay the dividend, it borrows the money and pays. This I think we discussed actually. He gave the example also. Please also confirm whether the unpaid dividend amount list is not filed for the 4 years. Can we file the one IEP for all the years? No, unclaimed dividend account for each year, no, 7 years getting over in each separate year. It cannot get accumulated on one particular year.
And now we will have V3, so we will have to wait how V3 will function.
That is another thing.
Yeah.
The meeting schedule is about to end. Action items of this meeting: open a separate bank account for the dividend distribution and ensure the transfer for the dividend account. That account for the Okay. You put it. Okay. An interim dividend can be declared after the close of the previous year financial, provided other conditions are fulfilled. I think that also somebody has actually shared it. Okay. Then is what?
There is a question, I think Mr. Chopra opinion that after closure of financials, dividend cannot be distributed. Why?
So I explained.
Yeah, explain.
I explained the very reason that you will have to reopen your financials. Otherwise, technically, there is a provision you can do that.
Yeah, you rightly mentioned.
Private company having a 1 crore reserve and surplus balance purely retain earning and want to close the company under section 248, can the company distribute among the shareholder as dividend?
Reserve and surplus, if it is a reserve, then it has to comply with the reserve provision. But if it is in the P&L account, balance in the P&L account, it can distribute the undistributed profit.
If there is excess money in the unpaid dividend account due to inflation rate, what need to be done in such money?
What does it mean due to inflation rate?
I am not able to get this question at all.
That
Actually.
they transfer
Because
the
of
dividend.
inflation, your money in the bank account will not grow.
Correct. And
Whatever the money deposited, the same money remained there. There is no question of
No. For foreign shareholders, they pay in rupee and they apply the exchange rate on that date. And if that rate get fluctuated, that's why the money cash component of Indian rupee get changed, no value, because they have to give it remit to overseas.
No, it doesn't happen, Dipti, that way.
That way they are talking.
They are talking that way.
Okay. So can you elaborate, Mr. Rajendra? Yeah, since he has asked the question.
No, it's very simple. We pay the dividend to the foreign, taking the example which you quoted, just explain. We pay the dividend to the foreign shareholder, dividend returned to us unpaid. The money remain in Indian rupees in the unpaid dividend account. And whenever he claim, again, we apply the current exchange rate and pay that. So there is no excess money which is generated on this account.
Okay, separate account for the interim dividend we discussed actually. Actually, who's responsible to maintain the shareholder KYP? Is it a DP or the company?
Just 1 minute, Bala.
Yeah.
Rajendra, please clarify that what you just said. Say, for example, at the time of declaration of dividend, say a foreign shareholder on repatriable basis, if he is entitled for say 1,000 rupees, you will apply the currency rate as on that particular date, right?
On the date of payment.
On the date of payment. Now that money has been, whatever he has not claimed it, the money has been transferred to IEPF account. Now again, he is claiming it. So that 1,000 rupees only will pay according to the current.
Applying the
rate.
current exchange.
That is what you said. Okay.
Correct.
Yeah. Okay.
Okay.
Because that 1,000 rupees will not become 1,001 rupee.
Correct.
Suppose whatever the dollars will be there, the dollars may come down or may go up. That's it.
Correct.
Yeah, that is right. Actually, who is responsible to maintain the shareholders KYP? Is it the DP or company? Can company believe on DP records and to verify independently?
If the shares are in depositories, with depositories in demat form, then DPs are responsible to ensure KYC and we use the information provided by DP. If the shares are in physical and you have a RTA, then RTA ensure the record keeping of the KYC. If the company maintain the record on its own, then the company is responsible to ensure KYC of the shareholder.
Is it possible under the Companies Act 2017, I don't know what is 17, I think there is a mistake, or amendment he is referring, an amendment of 2017 to reopen the account, all the accounts of financial, unlike Companies Act 1956?
No, these are depend on the fact and circumstances. If there are compelling reason, he can approach to NCLT and reopen the account. There are provisions. With the approval of NCLT, you can reopen the account.
I think that is all the questions. I have done with the questions.
In fact, I received Rajendra 2-3 appreciations from very senior members of the profession who seems to be that they are joined our webinar for the first time. Maybe because of your presence, I don't know that. But they said that it is a very good webinar and very good discussions have taken place. So a feedback for you.
Thank you so much. Thank you, everybody.
In fact, here also there is appreciation there. Today's session is very, very educative and very good, actually, clearly by Mr. Sudhakar Rao and the other panelists. So thank you very much for market coverage. That's what say Kushi Kapoor is actually saying from KMJ and company. Good session again is coming here.
Okay, I think.
Okay, I think let us check. Anybody has risen the hands or something like that, then we can check up. I don't see. Anybody has got any questions or something like that? Because I don't see anyone raising the hand.
We'll allow the raise of, if you raise the hand, we'll allow to speak. Anyone wants.
Yeah. There is one hand risen, I can say, Magesh Mittal. Magesh, you are there. You can unmute and you can speak. Magesh Mittal. Are you there? Because I can see that hand risen.
He must have raised by mistake.
Okay.
Maybe by
That is all.
mistake.
Otherwise, I don't see anybody.
Yeah, okay. I think all questions are answered since no one has raised the hand. We'll close this session. Thanks a lot for everyone for your participation. Thanks, Mr. Rajendra, for
Thank
a
you. I
really
must thank Mehta and Mehta for organizing this session and then inviting me for this presentation. It was
thanks.
extremely enriching session, I may tell you. And thank you, Sudhakar, for this, and Bala for this engaging, conversations.
And
Thank
we will
you.
trouble you. We will trouble you in future
Yeah.
also.
Sure,
Mr.
sure.
But
Mr.
this kind
Rajendra,
of
Mr. Rajendra, it was too nice of you. We are able to hear you repeatedly again in our session. We look forward more sessions as well. Thanks a lot. Thank you very much.
It's a privilege.
to
Thank you.
have this kind of debate, we would like to have that. We
Thank you.
love that. Thank you. Thanks a lot. Thanks. Thanks, Sudhakar. Thanks, everyone.
Thanks a lot.
Thanks, Mr. Bal. Bye.
Have a good weekend. We'll yet meet in the
Thank
next session. Thank
Sure.
you.
Yeah. Thank
Thanks,
you. Bye.
Nayan. Very good presentation by you.
Yeah, Nayan. Yeah,
Yes.
sorry.
We must thank Nayan because she has led the entire session.
Session. Yeah.
Thank you, Nayan.
Not
Thank
only
you.
the very good presentation, very lucidly she explained the things also. She
Yeah.
nicely she has
It was not reading.
narrated.
She was having her own
Yeah.
notes and
Yeah,
talking.
that
That was
she was narrating it
she
very nicely.
digested.
Yes. One question
Great.
has come whether private limited company which has only 2 shareholder does it need to open separate bank account? Yes, it need to open separate account.
Yeah,
we have
we
already
discussed.
explained the vulnerability of not opening the account. Thank you.
Thank
Thanks.
you.
Bye-bye.
Thank you.
everyone.
Bye.
Thank you.
Thank you.